Good morning. Debt funds and the new shape of CRE distress. Well, commercial real estate distress in the current cycle looks nothing like the aftermath of the global financial crisis. While headlines continue to focus on rising defaults and valuation resets, the data tells a very different story. Forced asset sales remain historically low, and the primary reason is structural. Private debt funds, especially those active in mezzanine lending, have fundamentally reshaped how distress is absorbed and resolved in a positive way. Now, distress sales are historically muted. Following the global financial crisis, distressed assets represented nearly about 20% of all commercial property sales by 2010. By comparison, distressed transactions accounted for only about 3% of total sales by mid 2025. And that's even with rising maturity defaults and property values have declined roughly 10% this cycle, far less severe than 23% year over year correction seen in 2009. Without deep equity impairment, widespread liquidation pressure has simply just not materialized. And private debt funds have rewritten the capital stack. Post global financial crisis, GFC, regulatory changes, including HV-CRE requirements, significantly reduced banks' willingness to hold higher risk construction, bridge, and transitional loans. And that void has been filled aggressively by private debt funds. Institutional capital has flowed into these vehicles at scale, giving them flexibility to price risk, structure creatively, and operate across senior, mezzanine, and preferred equity positions. And market data tracked by MSCI shows a strong correlation between rising dry powder and increased lending activity from these investor-driven lenders. Rather than pulling back during volatility, debt funds have leaned in, providing rescue capital and extension financing that prevents assets from being pushed into forced sales. And distress is concentrated higher in the capital stack. And the stress in this cycle is not primarily at the asset level. It's higher in the capital stack. Senior debt performance has remained relatively stable, with income accounting for more than 100% of total returns between 2020 and 2025. Mezzanine debt, by contrast, has absorbed significantly more pressure, and losses have pushed income returns above 200%, signaling that subordinated capital, not property fundamental, is where distress is really being realized. And mezzanine capital is reshaping workouts. Rather than defaulting directly into foreclosure, many sponsors are turning to mezzanine lenders to inject capital and extend their runway. And these lenders often gain control rights upon default, which allows them to influence any recapitalizations, restructures, or sponsor transitions more efficiently. And the result is a faster resolution, fewer legal delays, and a controlled workout process that preserves asset values. So what does this mean for investors and borrowers? Well, the modern CRE distress cycle is being resolved through capital restructuring and not mass liquidation. So for investors seeking exposure to distress, mezzanine positions often provide faster access to value with greater control and fewer headline risks than traditional foreclosure strategies. And for borrowers, understanding the evolving role of debt funds is critical when navigating refinances, extensions, or recapitalizations. And here's the bottom line. CRE distress hasn't disappeared. It's just moved up the stack. And debt funds are now the primary shock absorbers. And that is it for the day. Please visit my website, buildrapponline.com. Love to chat with you a little bit more about your scenario and see how I can help. Take care.